Welcome to the Pool Chasers podcast. I'm your host, Greg Villafania, joined by my co-host, Justin the Bearded Plumber Bowie.
Yes.
And today we've got Joshua Hayes and Buzz Giz with us.
Good to be here. Thank you for having us.
Thank you for having me.
Yeah. So we had Garth Stevens on, and we talked about an insane amount of stuff, and it more pertained to the law side of selling your business. And today we're going to be talking to a CPA, Joshua Hayes, on more the tax side of selling your business. So maybe you can give the listeners just a quick overview of what you do exactly.
Yeah. So first of all, it's fortunate that you had the law side on first, right? The tax side is the where the geeks live in these transactions. I've been a tax professional 30 years. I've loved every day of it, which makes me a unique breed in the world. My focus is typically heavy in the M&A space, right? Transaction advisory services. They all come with a very unique tax structure that I'm sure you heard Garth talk about, and just helping people who have built their baby from scratch. They build it up to a certain value. And it means more to them than most things in the world, right? So the opportunity to help them efficiently, move into the next phase and sell their company, it gets me out of bed in the morning, and I just really enjoy that piece of this very, very broad profession.
I know we can't name names, but you've been part of some deals with Buzz, right? And
I have.
Some other local deals.
Fortunate to be part of deals with Buzz. He's taught me as much as I've taught him. So.
That's awesome.
Yeah.
How far do you guys go back? You go back to the Paramount days or the Paddock days?
Paddock days. I've been here 17 years. So it's been 17 years, right? And
wow.
I met Buzz way back. He had a couple of unique problems in the world, and he asked me if I would help him navigate the problems and the solutions, which were complicated, and I think we did a good job at it. And we've been together ever since.
That's awesome.
Couldn't have done it without him. Absolutely.
Yeah.
He's been with me in every transaction, from the Paddock to the Paramount to other things that I do. I've lots and lots of trust in Josh. Yeah. And I know we can't name names, but Josh has been involved in 2 or 3 other pool transactions across the country. So he's very familiar with the pool industry, understanding of the pool industry.
Yeah.
Pool industry's been hot lately.
Yeah. We kind of talked about that a little bit before the interview, and yeah, it seems like everybody Buzz brings around too is good people. So thanks for taking the time.
Sure, of course.
Super appreciated. Yeah. As Greg said in the prior episode, we talked to Garth, talked about the law side. We want to talk a little bit about the tax side and how to get ready for maybe valuing your business or selling your business. So as someone who might be thinking about selling their business, what are some things they should be doing to get ready, and how can they expect to value their business?
Yeah, so getting ready to sell your business, it's a unique time in your life, right? Like I mentioned earlier, most people in your space have built it from scratch at some level, and it's the darling of their life, and valuation of their child, really, for a lack of a better term. It's interesting. It's meaningful to them. There's passion in their conversations with prospective buyers. It's not unlike selling your house, right? Curb appeal is important. Buyers that are, sitting around the table trying to establish the value of your business, you think it's worth a lot more than they think it's worth, and that sort of starts this conversation, again, much like selling your home. But to the extent you can get ready with your curb appeal, you will set the buying pool at ease. They'll feel a little bit better, right? It's not unlike trying to get a prom date, right? You get a nice outfit, you get your hair cut, you do your makeup or whatever, and then you actually have to get to the prom, so to speak. But that's really the starting phase of it, is curb appeal, right? And small business owners, specifically small business owners, they run their companies, very close to the chest, very near and dear to their heart. They oftentimes run it like it's just another silo of their family, right? They run a lot of things through their company, right? They they are undertaking transactions or buying cars or paying health insurance for key employees. They're running it with a specific purpose to lower their income tax, which is lowering their net income. And buyers don't necessarily love to see a small amount of net income, right? So oftentimes we have to pause the thought of what can I run through this company to what shouldn't I run through this company in order to make our net income try and grow to what it is, right? What it normally is, right? So we try to take out things that are tax-driven transactions. We try to back those out of the equation. Maybe you pay a little higher tax, but again, that's all in effort of showing that you're strong, showing that you have positive cash flows, that repeat over and over again. That's really the first step, right? Is how have I been running my business historically? And if I've been running my business with tax motivations in mind, that's another way of saying I'm lowering my net income. We want to potentially try and increase that back because, again, to the extent we can show bigger earnings of the company that aren't tax motivated downward trend, our buyers tend to be more comfortable with the price they're offering us.
Is there a way to do that where you don't then have to pick up all that tax? I mean, is there a way to show it on your books, but then not lose all of that advantage?
If there is, I haven't learned that yet in my 30-year career. The short answer to that is no. Again, in discussions with buyers, when you're in that arena, in discussions with buyers, right, we talk about adjustments to net income. Garth, I heard him talk a lot about this concept of EBITDA, right? And EBITDA, in its foundation, buyers are looking for normalized EBITDA, right? So EBITDA in a given moment in time doesn't turn into a sales price. They're looking for trends and they're looking for trailing 2 years, or you're trying to project EBITDA into the future, right? So to the extent we can take tax motivated decisions that entrepreneurs are making, show the buyers that those are not a normal situation, right? We call it we're trying to normalize EBITDA, to show you a picture of what EBITDA would look like, but for our own tax-motivated transactions on the company, buying a nicer truck than you might need. We would say the difference in a $100,000 pickup truck versus a $40,000 pickup truck, that is a normalizing adjustment, and we would try to grow EBITDA that way. So the short answer is no, you can't just have net income and not pay your income tax on your net income. What we can do is say our net income is artificially driven by tax motivations, and you need to consider that it should be up here.
Yeah, been in situations where whether we're negotiating a line of credit or something like that, it's always such a sticking point because you do so much to show so little to have a tax,
right?
And then you get penalized for it almost.
Yeah, bonding companies are the same way, right? I'm making tax decisions and they want to see net income, and you're trying desperately to show very little net income, and there's this natural sticking point between banks, bonding companies, and the income tax authority.
But Josh, is there a way to do it during the process of add backs? In other words, if you can prove that those aren't normalized items that you did, and you can add them back to the EBITDA, if you can prove the fact that, hey, listen, that's not going to be a reoccurring expense, let's say, when they buy the business, because they look for reoccurring expense. Well, no, we're going to extrapolate that out now and add that back. Talk about that just a little bit, because that is important for entrepreneurs that are doing what they have to do to manage their taxes.
Yeah, so the big one is wages, especially owner wages, right? So the owner might take an artificially high wage for some particular reason, right? At the end of the day, it's all their money, right? So whether they take a wage at a high level or take a wage at a low level, what we would try to do in that situation is go in and say a normal wage for this level of business by a unrelated third party is set at some level, right? And to the extent we're above that, we would ask the buyer to add that back. Right, to the extent that we're below that, we may have to reduce our earnings in that situation. But that's a good example. Some companies like yours, right? A tax savings motivation might be heavy retirement plan contributions, right? So we're taking a big cash outflow of the company, funding our retirement plans, and we might go into a conversation with a buyer and say, that's artificial because it's all mine anyway, and therefore you need to give me credit.
I see. Can you give us the breakdown on EBITDA one more time too? I know we kind of discussed it before, but
Yeah, so it's an acronym. It's earnings before income, taxes, interest, depreciation, and amortization. Right. That's the acronym. Typically speaking, it's net income. Right. It's a computation of net income. And then what they try to do is add back the non-cash factors, which is depreciation and amortization. Right. Those depreciation expense doesn't come with an outlay of cash, right? So that comes out, or it gets added back, right? Because it comes out of net income, but it's not cash coming out as net income. Interest is an important factor, right? Because the buyer is going to assume that they won't have the same level of debt that you have. They will assume maybe they have a lower cost of capital, so they tend to add that back as a unique expenditure on your income statement that they won't have to duplicate, right? So it's net income is a starting point. It's a good starting point, especially for directional views of EBITDA. But you always have to add back depreciation, amortization, interest gets you to EBITDA. Then we add our normalizing adjustments, like we've spoken about, unusual, one-time, very specific to your circumstance items, and then we end up with normalized EBITDA, and that really is the starting point. From that point, it's arithmetic, right? It's some multiple on EBITDA, but to the extent we can make EBITDA as large as we can make it, you tend to drive your price up, your valuation up.
so if I was going to sell the company, like when do I need to start making those adjustments? Like how many quarters do they look back generally, or how far ahead do you need to be?
Yeah, I trailing 24 months is a good rule of thumb. Maybe trailing 18, right? They want to see what you have done historically, right? Because they are going to they're buying cash flow. They are buying your ability to earn money into the future. So the starting point is, okay, what have you done lately? Right? That's 24 months, I would say. That's what they look at. To the extent you are trying to say, but my business is strong and it's growing and I'm just about to pop, and if you could see me 2 years from now, right, that now you're starting to project earnings into the future. That's a different concept that I'm certainly happy to address. But in a perfect world where time is on our side, I would say you start to adjust the way you operate your business 18 to 24 months ahead of a transaction date. But that's not the way it happens in the real world, right? Someday somebody
6
shows
months.
up with a checkbook and they want to close at the end of the month.
Yeah.
Especially as you get towards the back half of the year, right? So, there's no better time than right now to start. But you have to, they're going to look at 18 to 24 months. The other thing I want to broach specifically with the entrepreneurs of the world is this concept of a financial statement. Most small businesses keep a set of books and records so that they can give it to their tax preparer to prepare income tax returns, right? Buyers will ask for financial records. They want to review the last 18 to 24 months, right? You're going to hand them a set of financial statements. One thing to consider is, should I have my books and records reviewed or compiled? Some will use the word audit, although that's a whole different concept than today. But the question is, should I go through the expense to have some third party like me or a CPA, their current CPA, give an opinion on their financial statements? Buyers will love that.
An opinion.
Yeah. So what I would do is I would review your books and records, so to speak, and I would hang a letter on that says I've looked at these professionally and I think they're okay, right? Or they're directionally okay, or there's nothing in these statements that would lead some independent reader to make a different decision. That's fundamentally what an audit or review is intended to accomplish. But they're expensive, they're complicated, they're a long process. But again, if you see this transaction coming on the horizon, and if you had enough time, and there's a big chunk of the industry that believes if you undertake that step, moving to a set of financial statements, that there's a payback on the end with a buyer, right? Because a buyer is judging your business operations at a professional level, right? Can I trust what you're giving me? They're going to say that at some level, right? I'm going to write you a check based on what you're showing me. If you have a third party who puts their name and says, hey, it's okay, or it's pretty good, or it's close enough, they will be much more comfortable in terms of your level of professionalism, right? The way you run your business, and that will make them feel more confident when they start writing the check. I know in Garth's podcast there was some discussion, of escrow set-asides, et cetera, right? And that's usually where you will feel that.
Or they'll come and get it if there's an issue with what you've showed them.
Yeah. But if you have a set of financial statements, maybe the escrow set-aside is down slightly because they believe that the odds of what you're presenting to them are more accurate.
So is that CPA reviewed? Is that what that's called?
Yes.
We've had to give financials, and they've asked for that. We get monthly financials, but ours aren't considered CPA reviewed. Does it have to be a third party that does that, or can it be a CPA at the firm that does your bookkeeping?
Well, it has to be a CPA first of all.
Right.
That's the only designation that can hang that report on your financial statements for a third party to rely on. Internal financial statements work, right? I mean, there are many clients that bring us their financial statements, and we don't make any adjustments to them, right? There are some that bring them to us, and we have to, clean them up and recategorize things and show things different. And so there's varying levels of that. But again, fundamentally speaking, the goal of the financial statement is that every third-party reader of your financial statements knows that you're using the same rules as Buzz, and you're using the same rules as Apple, and that they're using the same rules as the hot dog store. All they want to know is, am I reading financial statements from people that are using a fixed single set of rules?
Gotcha.
Given what you know, say you're an investor and I have a business, say I'm a pool builder or whatever it may be, what would it take for you to buy my business? Like, could you give a checklist of things that you would need in order to move forward?
Yeah. Well, first of all, you should see me try to build a pool someday, and then that would answer your question right out of the gate.
It makes two of us.
Fundamentally speaking, there's two types of buyers in the world, right? There's financial buyers and what I call synergistic buyers. Some people have other names for it. People who know how to build pools and people who are buying an income stream, right? So let's just assume for a second that I'm trying to buy an income stream, right? I at some level, I'm agnostic to what you do. I want to know what type of earnings do you have? What type of operations do you have? What's the strength of your organization? More importantly, what's the strength of your customer base? You'll hear this term, quality of earnings report that's coming out there, and that's me saying, maybe you're a pool builder, maybe you're, the hardscape provider, whatever you're doing out there. What I'm really buying from you is an income stream, and to the extent you can show me that it's good, it repeats, it's solid, then I'm interested in buying that from you. Much like I would be investing in a bond or a stock on the New York Stock Exchange, what I'm really doing is outlaying cash and trying to earn a rate of return, right? So pool companies, especially over the last 3 or 4 years, as private equity financial buyers are coming down into this entrepreneurial space, fundamentally, if you could peel back the fact that at some level, they're agnostic to the type of company they're buying. Some are more attractive than others, but really what they're doing is they're buying a net income stream. So if I could give you a list, it would simply be, show me what you earn and show me that you can continue doing that out into the future, and then I'll buy that from you.
Very good. What are the biggest red flags in your eyes?
The biggest red flags, well, in the tax world, you'd never use the term biggest. A big red flag, right, is organizations that don't have sophisticated financial operations behind the scene, right? Somebody who's writing out bids in their truck, right, and they're calling suppliers on their cell phone, and they don't have an organizational structure that's taking place for that, right? And the reason that's a red flag is oftentimes, like it or not, oftentimes I'm buying you, not pool building company. And when I'm buying you and all of the lifeline of this company into the future is based on you, I need to make sure that you have somebody behind you that can
Can't
keep
die.
going with that.
Oh yeah.
I'd like to know, are there some other red flags? I like that.
Yeah.
Because I think that's good. I think there's a lot of people that are probably running a business that way still.
And there's nothing wrong with it. There's absolutely nothing wrong with running a business that way. But somebody who's going to write you a check for that, they need to make certain if the proverbial bus comes along that the thing that they're buying from you will continue earning money. So that's a big one. I would say, secondly, it's strength and quality of your earnings. Okay, so if you think about one and done type customers, right? If most of your customer base is one and done, that worries me, right? That worries me to the extent you can have anything that's in the subscription based services these days is interesting to buyers.
Service agreements.
Service agreements. Maybe you're a pool builder, but you have a servicing arm, and the servicing arm has guys like me that just pay the bill every month, and somebody cleans it. But the strength of the repeat customer business is valuable to a buyer. So again, and to put that into a red flag, what I would say is, if most of your business is one and done, that's going to be troublesome at some level to a buyer, because you start every year at zero, right? And what I'm buying is an income stream, and I need to make sure the income stream is there.
Not to get too far off path, but say you're a builder listening to this and you don't do that, because a lot of them don't service pools, and you're thinking about selling your company maybe in the next 5 or 10 years. Would you say it's a good idea to maybe start servicing those, cleaning them, so that you can show that there's some residual income coming in every month?
Well, I don't know that I understand the pain points and the hurdles of having that business. It's more employees, it's more issues there.
It's a lot.
It's a lot, right? And so again, if you set that aside and just talk in a vacuum for a second, again, certainly a subscription-based business is valuable to a buyer, but more importantly, it would be when we're talking to buyers, we're talking about maybe we're one and done, but really the referral sources that we get from builder A, they were their provider of choice, right? That's starting to show a buyer that I'm going to continue getting referrals from people building apartment complexes and people building hotels and people building single family homes, right? It's yes, I have to start from zero every year, but the amount of referrals that I'm getting from a broad-based referral network, that's significant, and they are going to come.
Have you seen any, different types of ways businesses are creating sort of a subscription model, whether it be through maybe online training videos, or maybe there's something technical that they've tacked onto their business, just trying to make it more, up to date?
Well, yes is the short answer now. Particular to the pool industry, I don't know.
It doesn't even have to be that. Maybe just, have you, what have you seen?
Yeah, so I can think of situations where I buy a product from you and the product has a technology component to it, right? And I buy a monthly subscription. The technology is doing something to the product, right, in real time. And so I buy a subscription for warranty and service and fixing the technology and monitoring the technology and seeing when it's going bad and making sure it's doing what it's supposed to do. The moment I shut that off, the technology becomes worthless in whatever product I have, right? So I'm now beholden to the subscription if I want the technology that's running the whatever I just bought to continue working.
So like a physical product that communicates with the application that you pay $5 a month for. If you don't have the application, it's not doing anything, like smart things or something.
Right. So I think about, and I'm making a hypothetical here, right? But I'm thinking about, my phone that turns on my spa. It's an app, right? So, the creation of an app that I might have to pay a monthly service charge to, and I know that if I forget to turn the spa off at some given times, that technology is functioning as a safeguard to myself, right? Some version of that. My chlorine or my salt system isn't working properly, right? That's some third party monitoring what's happening. And again, if I want that to work, I need the service, because the technology is worthless if I don't have the service add-on to it.
Greg, I can share a couple things to the pool building side. You asked what can they do to broaden themselves rather than being maybe pigeonholed just in swimming pools. Remodeling side of the business is big, because obviously if things, and they have slowed down on the new pool side, there's thousands and thousands, depending on what region you're in, of course, but let's just use Arizona as an example. I mean, there's 3, 4, 5, 600,000 existing pools, maybe more out there. So what always have to be, something has to be done with a new pump, a new filter, new plaster, new tile. So if they broaden that and get into, say, the remodeling side, rather than just pools, that's an income stream I think they're going to look at that's going to be really important. And when you say service, it's not always, going out and putting chemicals and brushing the pool. It's servicing. It's that new pump. At Paddock, we had a remodeling and service division, and we didn't service pools by cleaning them and putting chemicals. Service was, the remodel was new plaster, new tile, new deck, or whatever. The service side was that new pump and new filter. That's a big part of a business that kind of puts more arms and legs out there for a builder to create more income stream. And I think that's going to be important as a buyer takes a look at that, rather than just being a single, source of income as just pools. As you broaden yourself, you could do that. I guess that would be an avenue to do.
Yeah, the cyclicalness of builders in general, right? If you can show that in the down cycles, I have X amount of my revenue is remodeling pools, right? Because if we're in a high interest rate environment and building is slowing down, people have to remodel their pools and service them, as Buzz, retile, resurface. If you can show that you have a strong income stream in up and down environments, you're going to be much more attractive to a buyer.
What about storefront?
Well, you talk about like retail.
Yeah.
Yeah. Well, obviously, I come from the retail background at Paddock. Absolutely, it's a whole nother arm that you could have a great income stream from. It's complex. Retail's a whole different bird, than construction, and you better be prepared for the retail side. There's all sorts of things, turnover and inventory and things that go into retail that isn't on the pool side. So you better have if you're going to dip your toe in that, I think you have to have the expertise in the retail side, or hire someone has the expertise in the retail side to run. But it's an absolutely great income stream, great margins in the retail side. And I think one of the things at Paddock we wanted a client from the beginning to the end. So whether they bought the pool, we serviced it, they came to our store to buy chemicals and furniture and pool fun and whatnot. So we had them for life, basically. From womb to tomb is what we had a customer with. So that's another great revenue stream. Different animal, though. Different animal.
Yeah, and
It's a
design.
lead generator too.
Oh, yeah. Every time they walk in the store, we would have a way for them to generate. They may not have bought a Paddock pool before, but they're in a Paddock store, and hey, I think my friend's thinking about a pool, or I'm thinking about a new pool. Absolutely, great way.
Yeah, and design. I spoke over Buzz there, but design. I'm a newly minted homeowner, and I want to build a pool, but I have no idea. I look up there, I think that looks cool, and when I walk into the storefront, I want somebody to sit down with a computer system and show me in real time, this is what's going to happen, right? And there's a lot of ways of charging for that when you're the pool builder, but again, to the extent you can show ancillary services, right? Because services are an important add-on. They tend to happen over and over and over again. And to the extent you can look into that arena, again, I do think you show diversification, which means in times when one is down, one is up. And again, that speaks directly to the strength of your earnings stream, because fundamentally that's what I'm buying, is an earnings stream.
Going back to that one and done, just thinking about my business, I've always, not that I plan to sell the company, but I'm thinking things and I hear things, and someone mentioned to me, you should try and have a contract with your builders, that basically locks them in for 12 months to use you. Like, if you don't have contracts, how do you demonstrate you're not a one and done? Because I could tell like a private equity company, hey, I have a relationship with Paddock, but there's really nothing locking them in. I could screw up tomorrow and they could fire me. I mean, is there a right and wrong way to do that?
I don't think so. I think, if you don't have a contractual obligation for them to use you, I think that's where you build your story, right? You tell your story of, okay, I don't have a contract, but if you look over this population of builders in the past 24 months, certainly, the 36 months prior to that, and however long into the future, and say, C, of their 80% or whatever, they send to me because they know I do a good job, right?
Okay.
Cost is irrelevant, but there's no good way other than demonstrating to them with actual results that you are the pool builder of choice, right?
Gotcha.
That's telling a story, right? And again, this goes back to that curbside appeal conversation we have, is you have to tell your story. You have to get them believing in you and getting them believing in your story. And that's oftentimes what will get a buyer excited to buy you in particular to the 3 or 4 or 5 or whatever competitors are out there in your region. Is, I believe you. I'm buying you as much as I'm buying this income stream. That's.
But Josh, don't you think Justin's a subcontractor, premier pool plumbing contractor in the state of Arizona? Don't you think there'd be some value if he had a contract, let's say with one of the big, whoever he has it with, that he can show somebody that, hey, I'm here for, again, any contract could be broken, things can happen. Don't you think there's any value in him sitting down and showing the potential buyer that, hey, I've got contracts with these 5 big builders in town, that I am their plumber. I'm here. Unless I screw up, I'm going to be the guy for the next 2 years. There's just any
value in contracts for sure, right? That's stickiness, right? That shows a buyer you will have, a revenue stream at some point into the future, right? But in lieu of that, right? If you don't have that, you're back to selling yourself and selling your story and showing them, yes, I don't have a contract today currently for whatever the reasoning is, but they know I'm the guy that does the pool, and they send me their contracts. And again, even in these situations, it's not uncommon for a buyer to want to talk to your major customer, right, or your major supplier. So it's not uncommon for them to want to know, because again, they're trying to pull back the covers on this thing and see this, what are the odds that the moment after I write you the check, that contractor stops calling. They want to know that. So I would, if there's no contract, you tell them the story, they believe it. It's not untold that they would want to, at the appropriate time, and that's part of this too, at the appropriate time, have a conversation. And contracts, by the way, if you do have contracts in this arena, you have to be very careful when you're approaching a sell, especially as approaching an asset sale, right? Because there are contracts that have language written into them that says, if you sell, you need to alert us an appropriate amount of time, right? And we may even have some approval rights for you to sell our contract, because fundamentally that's what you're doing, is selling their contract to a buyer.
That's why you want Garth to write your contract, by the way.
He'll
make sure that's not in there.
Yeah.
So you know what? I was thinking about you, Justin, or any trade contractor out there. I gave you some ideas on a pool builder going into remodeling or service or retail to broaden. I often thought about what a trade contractor could do, like yourself, would be broaden yourself. We dig the pool, we plumb the pool, we steel the pool, we electric the pool, and then we turn over. If you don't want to get into gunite, that gives you 4 streams of income rather than I just plumb pools. No, I dig them, I plumb them, I steel them, I put electric in.
Right.
Wow.
Yeah.
To become valuable to someone, that's big. In my opinion, it brings a whole bunch of more income revenue stream to the value to your business.
Yeah. We've done it twice. So, it's nice because you already have the client base. You offer another service and you're in.
Oh, you're in.
Yeah.
Especially with your reputation. It's like,
Yeah.
And buyers are looking for that one-stop shop right now.
they are.
Right?
Are they?
The chatter about how long contractors are taking to do things, right? If you can show up to the job and do it all, start to finish, soup to nuts, whatever the term is you want to use, that is intriguing for a builder, so to speak, not a buyer of your company. Well, it's intriguing to them also, but in terms of signing up people who are buying pools, valuable.
I want to inject a question here. why is it so hot right now? They're coming in and looking at the pool companies. Like, why? And when do you think that's going to run out? Because I know we've been hearing about it for a while. What do you think that's about?
Well, I wish I knew when it was going to run out. I'd be a popular commodity to most of the listeners on this podcast if I knew what day that was over. What I would tell you lately in specifically the pool manufacturing industry is, we had this run up of home building, especially in the Southwest, right? Home builders, interest rates were coming way down. You have a lot of young people coming out into the world. They can pay rent or they can buy a house. There was a time when those were very similar in terms of their monthly cash outflow. So you have this big boom in house building. It's cost effective for people, young people, to people downsizing, to people in the middle of their income earning to upsize, so to speak. It's all stages of the buying market are working at the same time. So that's thing one. There's just a natural progression to the Southwest, right? There's people retiring here, and we have this big retiring group of people focusing here, focusing on the Florida areas, focusing in the Georgia areas. That natural migration is happening. So that's one. Then we have COVID that comes along, and people are now stuck in their homes, right? And if I'm stuck in my home and I've been looking at my backyard for however long, I think, well, I'm not going on vacation and I'm not eating out. I might as well make my backyard nice, or I'm going to build my dream backyard. So there was this big uptick, and I'm speaking to the choir here, right? But there's a big uptick in people wanting to spend their money in their backyards. And again, so this was this peak of low interest rate environments, lots of building, lots of dollars with people that can now afford to buy and build, makes the pool cycle increase. COVID hits, it really ramps up. And when that happens, right, when you get into that phenomena, people buying income streams are buying hot markets, right? They're buying cash flow fundamentally, and there's a lot of cash flow in that business right now. There's a lot of repeat business out there, right? There's a lot of people moving up the chain in homes, a lot of people downsizing in the chain of homes. And when you get into that environment, a buyer is going to come in and say, I want to buy cash flow, I want to buy strong cash flow, and this is a strong market. So pool companies, pool builders, pool servicing companies became a hot commodity. Because if you look into the Southern California markets, right? If you still look at the number of pools in backyards, it's not like everybody has one, and so there's still a lot of runway to continue putting pools in, cost effective. That, in my opinion, was the strength of the market over the past, we'll call it 4 years. I've had many conversations with people that says, is it better to have curb appeal or is it better to sell into a hot market, right? What do I do here? I'm not ready for sale, but gosh, the offers are coming too fast and I don't want to be the last one without a prom date, right? So I would tell you this, selling into a hot market is valuable, right? You get bidders bidding against each other for your company, right? That's a great circumstance for a seller, is having 2 or 3 companies that want you. That's one, right? You'll have more bidders in the space. Second, and this is the part most people forget about in the sell side transaction, you will have defensive players coming in, right? So, for example, if you dominate the Arizona market and there's somebody in Southern California, let's call it Texas or something, they may acquire you so that somebody else doesn't acquire you, and now they're in their backyard, right? So in terms of selling into a hot market, you can play both sides of the transaction. It's like, I'm a good company, buy me, or I need to buy you before somebody else does, because now my market share is at risk. So that's the value of this concept of a hot market, is your population of buyers tends to expand significantly.
Is it still hot right now? Like, does it seem like there's still activity around it?
It's happening. I would say it's slowing down. Slowing down for a couple of reasons. One, interest rates, right, making it more expensive to put in a pool, for sure. that's one. But more importantly, the buyers have a higher cost of capital, right? So the people who are writing you the check, they have to borrow the money or they have to get investors. In order for them to attract their money with which they can buy you, they have to pay higher rate of returns to their investors. They have to pay higher interest rates to whoever's giving them the money, right? So it's this perfect storm of the costs are just expensive, right? And again, it's not gone away. People are still interested and they're still looking at pool companies around the country. I still know of pool companies that are being talked to and courted, but what I'd say is the cycle has slowed down significantly.
Okay.
Yeah, there for a while was almost free money for these private equity firms.
Yeah.
Let's face it, they had to deploy the money somewhere, and they see these high, income stream companies like pool companies. So they were hot. Now money's more expensive. Rate of return probably isn't as great as it was when it was 2% money. Now that it's 6% probably today. Big difference.
Yeah.
Big difference.
Yeah,
and maybe when it was 2%, they might have paid more for a company too, a little bit more because the money was so cheap. Now it's not as cheap, so valuations may not be as great as it was. I can't for surely say that. This is my gut saying that.
Yeah.
Yeah, that's right.
So what is the valuation process, and is there a multiple someone in this business could expect, or how do you come to that value?
Yeah, so the valuation process is unique, right? Fundamentally, what a buyer is asking themselves is this question: how long would it take me to duplicate that result? Okay, so if I could go across the street, put up my shingle, and duplicate your company in 5 years, right? I'm not better off to pay you a 5 times what you're doing currently, right? So if we think about multiples, people say they got a 5 multiple or an 8 multiple or a 10 multiple, right? If you can peel this back to its most basic level, the question is, how long would it take a competitor to duplicate what you're doing? Because if it's 10 years, they're better off to pay you an 8 multiple for your company if it takes them 10 years to duplicate it. If they can duplicate it in 3, they're not paying you a 10 multiple because they'll just go duplicate. So that's the basics, the basic premise of valuation. So everything comes back to really an arithmetic equation. Your EBITDA, your normalized EBITDA, right? And how long do they think it would take them to duplicate it? That's what they're willing to pay. Now,
Even the private equity guys are thinking that, because they're not.
Yes. How long would it take them to duplicate that rate of return, right?
Okay, so not necessarily duplicate your business, but get that same return in some other endeavor.
That's correct, right? Because private equity, again, they're financial institutions at their most fundamental form, right? They are investing money for a rate of return. So if they can invest money somewhere else for an equivalent rate of return, they're not going to pay you for it. They will go over here and pay or invest in some other property or some other business if they can duplicate that rate of return, right? If you're talking about a synergistic buyer or somebody that's in your field, another pool building company or another pool service company, right? What they're looking for in their valuation is what do you have? What secret sauce do you have that they need? Okay, what do you do that they can't do? They need it. You have it. They now have to decide how long would it take me to duplicate that, and if it's too long, I'll buy it from you. If I can do it quicker, there's no barrier to entry. You don't have any magic. You're just really good at it. How long would it take me to get all your referral sources? And they'll look at that and they will analyze it, and they will say something along the lines of, if I can duplicate that in eight years, I'll give you a 7 multiple, but I'm not interested in a 9 multiple. So that again, that's the fundamentals of how we establish the multiple, which is, again, an arithmetic equation of that times the EBITDA gets you your enterprise value, the value of your company.
So they kind of work backwards from, if it took me 10 years to duplicate this, it's worth it for me to give him 5 times instead of risk the 10.
Correct.
Yeah, I see.
Yeah, correct. And that's all of the discussions. And again, this is a broad a real broad question is how do you get to valuation? But if you can try to put it into an easily digestible scenario, that's really it, right? If I want to invest in a share of Apple stock or a share of Microsoft stock, what am I interested in? What am I going to get back? What kind of income am I going to earn off of that? Well, if one's at $300 a share and one's at $100 a share and they pay me equal, which one am I going to do? I'm the $100 a share, right?
For sure.
And the risk is the same, right? That's the piece of this. The risk is the same. So a buyer will look at a company, a pool building company, with that lens on, right? Now, a financial buyer and a synergistic buyer, they may invariably pay you different multiples, right? So again, and it's a conversation that Garth and I have had. I've had in many deals. Garth and I have had on several deals, including some pool companies, and that is all offers aren't equal. You have to analyze the offer. So if somebody says, I will give you a 10 multiple for your company, I will give you a 7 multiple for your company. If you do the math, one's bigger than the other, right? But then you have to start peeling back in terms of what's the rest of the story in that offer, right? Why are they different? I will tell you, synergistic buyers or other pool companies, people in the pool space, they oftentimes will give a higher multiple than a financial buyer, right? Because a financial buyer is a race to the bottom. It's the least amount I can pay for the highest rate of return. I don't know how to operate a pool company. I'm just buying a rate of return, right? That's a private equity. They need you to stay in to operate the company. They don't operate pool companies. They operate financial calculus to say, what can I outlay here to earn the highest rate of return? A synergistic buyer says, gosh, if I take my pool company and their pool company and get another pool company, and we all do similar things, but we cross over somewhere, if I can put that together, I now service more things. My company is stronger, and they oftentimes are willing to pay a higher multiple because you have something that they need. They're not buying your rate of return. They're buying something that they need.
What are some of the things when you say one's a 10 and one's a 7, but you got to kind of peel the onion back? What are the things that you look for? What would make that 7 maybe better than a 10 when you start peeling things back, like so much equity you got to leave in the business, or the way it's tax structured could be costing you more tax? Kind of talk a little bit about that, because that was interesting when I was doing my deal.
Yeah, so a good example, and this goes to the underlying transaction type, right? If a buyer is buying assets from the company, right, they're going to give you a check and they're going to get assets, and they're going to hopefully depreciate those assets as fast as they can, which is taking their outlay and income tax affecting it sooner than if they buy something else, right? So if at the same time, if somebody buys stock from you, they don't necessarily get an income tax deduction for buying stock, just like we don't get tax deductions for buying a share of Apple. They will pay different multiples based on what they're buying, because their cost of capital goes down if they can income tax affect their outlay sooner. So somebody buying assets who can take a big deduction for it may pay you a higher multiple than somebody that's buying your stock who can't take an income tax deduction for that quick.
Define assets. You mean like vehicles, a building, physical?
Desks,
physical.
supply, inventory supplies, all the things, a rolling stock, your trucks, your shovels.
Gotcha.
But not liabilities.
Not liabilities. Yeah, that's a
Yeah,
it's a whole other situation. Yeah,
I think Garth talked a little bit about that.
Yeah, Garth did talk, right? So in a typical transaction, they're going to come into your company if it's an asset sale, and they're going to say, we want to reach into your company and we want this asset, this asset, this asset, and this asset. Here's a check. You're left behind with whatever else is left behind in there. The liabilities is a big one. And they've taken your assets out and exchanged that for a check. They get to make income tax elections on all those assets, right? That reduces their cost of capital. If that's the scenario here, oftentimes their multiple may be higher. Now, again, if we're talking with our tax lens on, oftentimes that's a worse tax consequence for you, right? So again, a point that I want to make here that's important is selling assets versus selling equity. Buyers want assets, sellers want equity. The reason is the income tax consequence to the sellers are dramatically different, probably. Okay, the liability side that's a different conversation. But typically speaking, and I tell this to people all the time, right? It's the beautiful complexity of our tax code, right? What's good for the buyer is bad for the seller. What's good for the seller is bad for the buyer. That is purposefully written into our tax code so that Congress can believe that buyer and seller will get to the right answer because what hurts me benefits you and vice versa. And if that's the case, our negotiations are going to be more real and more at arm's length with each other, right? So again, if I'm buying your assets from the company, you're going to have a bad tax answer. I'm going to have a good tax answer, probably. There's always a probably in the tax world. If I'm buying your equity, I'm going to have a bad tax answer. You're going to have a good tax answer. So if you were just to set those two right next to each other on a piece of paper, the multiples might be different.
Yeah, I know I'm going to say this wrong, Josh, or the terminology, but let's say in an equity or a stock purchase, the buyer can elect to do an H10, which gives you the stock sale. But of course, again, what's good for the buyer, it wasn't good for the seller.
Sure. So, yeah, so you're into advanced tax class now for a second, but in the tax world, everything's a maybe, right? Everything is this is the general rule, and here's the exceptions, right? So, one of the things that's evolved over the past, however, I've been 30 years, and there's been evolution even in that time, is this concept of tax fiction, right? Which is, I can buy your equity for state law purposes. So it's an equity sale, and we can talk about why they might want to do that. It's an equity sale for state law purposes, but we pretend it's an asset sale for income tax purposes, okay? It's this hybrid sale concept. That's what Buzz was alluding to, this 338H10, which is way outside of today's conversations. But suffice it to say, there is a hybrid method in the middle, which is actually fairly common in today's world. But generally speaking, if you sell assets, even if you make believe sell assets in this hybrid method, you're going to end up with a worse tax answer than you would if you sold equity.
If somebody buys buys your assets in an asset sale, does that reset the clock on them if you've depreciated them like in your business prior?
It does, right? So if you buy a truck and you depreciate it, and then I come in, I'm a third party, I buy your truck from you, I now have a cost basis in the truck or the check I wrote you, and now I get to depreciate. That's the concept we're talking about. If I go into your corporate shell and I pick up all these buckets of assets and I write you a check for them, I start redepreciating those.
Right.
So the clock starts over. That's what they're commonly seeking. Because again, they outlay a check, they get a big income tax benefit from doing that quick, and that's of value to them.
So what do you think, based on your experience seeing these other pool companies like Buzz's, what do you think a pool company could get a multiple? Like what's normal? Or I don't know if normal is the right word, but
yeah, normal isn't the right word because again, I wish I had a better answer. It's all over the board, right? It depends on, is it you and your truck writing out purchase orders? Is it does there a corporate office that has a sales director and a marketing director and an operations director? Those are going to get different multiples. I would say, again, very generally speaking, if you look at the life cycle of the company, right, a brand new company who's just starting out, who's got a few good wins, but they look just like everybody else, they're going to get a small multiple, maybe
3,
1 or 2, 3. I would say if generally speaking, if you're at a proven level of success, a sustained level of success, you're probably in the 5 to 8 range.
Okay.
And then, as we talked about earlier, there's all sorts of variables in that. What are they buying? What do you have? I will tell you this: there is a different pool of buyers See what I did there with pool? No, there's a different group of buyers with EBITDA of 1 million and 2 million than there is when you get EBITDA to 5 million, 6 million, right? That's a different group of buyers. And oftentimes a company with 5, 6, 7 million of EBITDA may get a better multiple than a company with 1 million, 2 million.
Just based on the sophistication.
Just based on the sophistication, based on how much work the buyer has to do on the company, right? After they buy it. If it's you and your truck, with your checkbook and you're writing out payroll to your contractors, or writing out payroll to your key employees, somebody's going to have to add a lot of things to that to scale it. If you're already scaled, they may give you a higher multiple just simply because of that fact, right? So multiples, it's a dangerous conversation. I would say if you can get yourself into a situation where somebody can see that you are scalable, they'll give you more money, right? They'll give you a higher multiple. If they think they have to come alongside of you and help you, think about Shark Tank, right? Think about that. Well, I love what you're saying. I love what you're doing, but gosh, I'm going to have to do so much to get you from here to here. They're going to pay you less for that company.
What are some of those terms in the contract that might be attached to, like a private equity company going in and buying, giving you a higher multiple, buying one of those pool companies? Like, do the private equity guys say, is it ever like, all right, I'm going to give you a higher multiple, but you got to stay on 4 years? Or what are those general contract terms that make you get that higher?
Yeah, it's a great question. Think about this. A financial buyer, they don't really know everything about running a pool company, right? They're buying an income stream. They are buying you or the strength of your company, right? They need you to have skin in the game, right? You're telling them a story, they're buying your story and writing a check. When you're the check writer, you want to make sure that the day after you give me the keys and I give you the check, the whole thing doesn't just evaporate, right? Mm-hmm. So when you look in the contracts here, in that type of a situation, oftentimes in order to put you at risk with them, they're going to ask you, you need to stay on for 2 years. We'll pay a salary, but you need to stick around for 2 years. That's a big one, right? That's all they're trying to do is tie you to the continued success of this company. Because if it's you and not the company, we need you here. That's one big one. The other common scenario in these is the concept of an earnout, right? And the concept of rollover equity. And in those situations, let's just do rollover equity first, right? Maybe you're Buzz and you're Smart Money, right? So they say, hey, listen, we want your company, but really we want you, right? We want your knowledge and we want your expertise and we want your company too, but what we'd like is you. So if instead of us giving you a check, we'll give you a check for half of it or 70% of it, and then you give us 30% as an investor in the company that we just bought. Now what they've done is they've tied you into the growth of your company from the moment they take ownership and forward, because you still have skin in the game, right? You still have an equity investment in the buyer company. That's more common than most people probably think. Most people think I'm going to get my check and yes, I'll stick around for 2 years. We'll hate each other by the end of those 2 years, and then I'm down the road. That's actually few and far between. The concept of earnout, there's a variety of uses for the earnout concept. Typically speaking, if you're telling them, gosh, my last 2 years aren't great, but my next year is going to be spectacular, and the year after that's going to be spectacular, right? Let's just say that's where we are. You want a higher multiple because you know tomorrow's better than yesterday. If you're in that scenario, they may say, fine, I like what you're saying here, but I'm going to make my sales price contingent on what you're telling me is going to happen tomorrow. So I'll pay you an 8 multiple, but I'm only going to give you 5 today. And if you do what you say you're going to do, then I'll give you that other 3 later. That's the general concept of an earnout. That's why I say all multiples aren't the same. It depends on the construction of the deal. But if you say I want an 8 multiple and they say it's 5, you say sorry, it's 8 because I'm about to pop, they may say, tell you what, I'll give you 5. And if you pop, I'll give you the other 3 later. You got your 8 multiple. All they've asked you to do is put your money where your mouth is, right?
I have a situation, a guy I know who sold a company, and they put on the table, like, he's got to stick around, but he's also got a carrot out there. Like, if we break this, you get X, like a multiplier of like his deal, which I thought was pretty cool.
Yeah. And again, yes, those exist. For today's talk, where to look for those, right? Where to look for that, or even where for you to put that in the contract is if you're trying to get a higher multiple, right? You want 10, they want 5, right? You might say, fine, I really believe in this company still. I'm just taking some chips off the table. I need new capital for growth. I need your money to grow this thing, but I really think my success can scale and it can grow. I'll tell you what, I think it's 10, you think it's 5. Give me 5 today, and I will put at risk that multiplier. If we hit these targets, you'll give me more sales price. And gosh, if you're a buyer, that's okay, right? If you do what you said you're going to do, oftentimes they're fine paying it for you. They're just not going to give it to you up front, and then at the end of the cycle have to try and go get it back from you because what you said was going to happen didn't happen.
Talk a little bit about the possible upside for a buyer when they roll that equity back in and they keep 20 or 30% as equity. Most private equity or equity money holds things 4, 5, 6 years and then tries to turn around and hopefully put a 30% return or whatever return they're going to put on. So the possible golden parachute for a builder by leaving equity into a business, if that private equity is successful in a 5-year, 6-year, whatever period of time, and they take that now and put a 30%, is that about what they normally look for, 30, 40%, your X amount of money in this parent company goes from X to Y big time.
So you get the growth.
You get the growth.
I see.
So now again, that's the gamble you take. Or a lot of these private equities will buy several pool companies. Now they've got a pool company maybe doing $300 or $400 million worth of business because they bought 5 or 6 across the country, and then they end up selling it to another private equity or going public or something. Then your equity stake in that business could go. That could be really where the big money could come down the road. Did I articulate that right?
Yeah. No, you really did, Buzz. That's. But again, that's the danger of 2 multiples on a piece of paper are equal. That's the danger in it, right? If we're talking about private equity, oftentimes we do reverse due diligence on the equity, right? They want to come in, they want to look at us and see if our where is attractive. We also want to look at them and say, hey, if we got to roll 30% of our company into yours, we want to know what your plans are. And they may say, hey, listen, our goal is to make 1 + 1 + 1 7 5 years from now. Well, oftentimes the rollover equity turns into something more than the original sale was.
More
right?
benefit there.
Right? That's again, that may be something that is of interest. If you're 75 years old and you're just done with building pools, maybe that doesn't interest you. But again, that in terms of valuation, the key takeaway for today is when you get your offer sheets, if one of them is a rollover equity, you want to go to the equity company and say, what are you doing with my money? If the answer is we're trying to buy a bunch of pool companies and in 5 years from now, we're going to turn it again for a bigger multiple. Remember, at a certain level of EBITDA, there's a different grouping of buyers. If they can get you to the new group to 50 million of EBITDA, there's a big group of buyers out there that would love to buy that. It's sustained cash flow. So oftentimes we're now getting deep into your goals. If your goals is take some chips off the table, but I still like building pools, that becomes more attractive. They may pay you a lesser multiple, but your upside on that second bite at the apple, so to speak, is significant.
Or you might not even have a choice. That's just maybe the way
may not have a choice.
They just may tell you that's what we're going to do.
Yeah, but just to go back and reiterate, your question was, talk to me about multiples, and what I'm hoping I'm articulating for the group is it really depends on the deal structure. Because a multiple alongside of a multiple, if the deals are different, they may yield the same in the end. So you almost reverse engineer to the multiple. This is my goal. This is my net in my pocket. I went and talked to my tax advisor. They calculated the income tax consequences. If I work backwards to I need this amount of money to make this deal tolerable, that might be different than the one next to it, which is cash and carry, so to speak.
So we may have kind of already answered this, or it might be the same answer to a question I was asked earlier, but I'm going to flip it around a little bit. So let's say you're not the seller anymore. I'm the buyer. I own a pool company, and I'm trying to determine, do I grow my company or do I buy a company? Like, how do you think you make that determination? Like, what makes more sense as the owner? Like, I guess that would make you one of those buyers you said, specialized buyer, I guess.
Sure. It's an interesting dilemma. What I would tell you is your level of sophistication in operations is clearly number one, right? Growing a company, you cause chaos, right? If you go from a 10 employee level to a 100 employee level, that's a different thing, right? Your time is now being drawn away from what you're good at. So, if you can buy a ready-made company that has an HR department and has a director of sales and a marketing arm, et cetera, that would be more attractive. So do I grow and scale so that I can sell down the road? Again, fundamentally, it's a rate of return conversation in your own mind, and that is, what will my time being pulled away from what's made me good? That's gonna pull you in different directions. Growth, it takes capital and it takes time away from what you're good at, what's made you what you are. That may be okay, and you may get there, and you may pick up strategic pieces in the business operations as you go, but you might not, right? And that's always the risk of growth, right? There are companies that grow too quick, and they crash very, very quickly. And it's not that they can't still build pools, right? It's that they got pulled into so many different directions that aren't their expertise, right? So again, growing it, buying it, again, that's fundamentally, like you said, it's the same conversation we've had. It's a rate of return calculation at its best. The cautionary tale there, in my mind, is, can you be successful at what you've done historically while you are growing yourself? That's the key focus, right? You will take away from what you're good at to grow. If you can buy that ready-made, so to speak, there's all sorts of intrinsic value in that. Plus, you may take what they have built already. When you overlay that onto your company, it gives you more time to go out and do what you're successful at, right? So I don't think there's a magic answer to it, but the key focal point there is, how much chaos will it cause in my daily life in order for me to grow this? Because it takes your eye off the ball.
Seems like a good team would be that private equity guy who just wants, and then the guy who wants to grow, and you put them together and you fund this guy properly to go in and grow it for you. That seems like the way to do it.
Especially private equity that's in growth mode, right? If you can submit to the premise they want 1 + 1 + 1 is 7, right? When they're looking at companies, maybe company number one, started this from scratch 60 years ago and they want to retire, but they have a heck of a strong business, right? Maybe company number two is in growth mode and they have a 35-year-old president who, is in for the long haul. Well, private equity might say, ooh, if I take those two and put them together, I now have solved my operations problem because I have person to grow, right? That makes company number two just as darn valuable as company number one, right? So again, they're looking at these companies and trying to say, which of these puzzle pieces can we put together in order to make 1 + 1 + 1 7? And that's their goal. 5 years to try and make that multiple big, so that when they turn it, that's how private equity companies make their money, is when they resell the package. They don't really make any money in the interim, right? Because they're taking the cash flow and giving it to their investors. They make their money when they resell. Okay?
Is that right? Most of it just
Yeah.
goes back to interest back on there.
Yeah, the common deal is they take a 2% fee or something, but that just pays their wages and but the rate of return coming out of companies is going to their investors, right? So their incentive, private equity's incentive, is that second sale, that second bite at the apple. That's how they're compensated. Okay.
What might be the difference in the valuation of a company if being bought by a strategic buyer or private equity?
Fundamentally, the question that you have to ask yourself, you just take the math out of it for a second, right? Fundamentally, you have to say, why are they buying what they're buying? Okay. A strategic buyer, I call it synergistic buyer, but strategic is the same concept, a related entity. They are buying for growth, just like the question we just talked about. Maybe it's easier to buy you than it is to grow it myself, right? So that might be a reason a strategic buyer might even overpay for that company so they don't have to grow it themselves. Maybe you have a specialized process that they're tired of competing with. When they go out and do a bid, they're sick and tired of seeing you there, and they know if you show up to bid against them, they're done. They may now be interested. That was back to that defensive situation that we may have talked about earlier, but you have a secret sauce, or you have a process that's specialized, or you've figured this thing out better than they have, and a strategic buyer may want to just A, take you out of the marketplace, or B, join your group with their group to make yourself collectively stronger. Those are the things you look for in strategic buyers. Those are the things that they're looking for is, what do you have? Can you solve a problem that they have, right? Maybe they have a founder that's aging and trying to retire, and maybe they don't have a good succession plan in place. And they know if they acquire your company, you've fixed their succession plan, right? So that's not even an operational thing. That's to strengthen themselves. So I tell people in the synergistic space, the strategic space, they're trying to make themselves stronger by growth or growth through acquisition. Financial buyers, again, they're financial institutions at their heart, right? They are out there looking for rate of return that they can pass on to their investors, and they're looking for strong rate of return, and they're looking for cheap rate of return.
I could totally see like a manufacturer buying a pool building company. Maybe they don't have as much market share, but say you manufacture tile. This gives you an opportunity to tile every single one of those pools with that tile, and then maybe you partner up with a pump company or something like that, and
Yeah, you're talking about strength, right? That's strengthening themselves, right?
Has there ever been anybody, maybe not in pools, but I could just see somebody like strategic where they know that there's going to be a city with an insane amount of new infrastructure. There's going to be 1 million homes built over here. I'm just throwing numbers out within the next 10, 15 years. And somebody's like, man, if you had a pool build company, and the owner probably has no idea this is happening because it's.
Are you talking about a company that's building out in North Phoenix right now?
Maybe.
You're again, one-stop shop. Strengthening yourself where you're not beholden to risk. Right? If you're in the market for building luxury homes, and there's nobody to show up to build a pool, it's going to be exceedingly difficult for you to build and sell a luxury home. So it may very well be you reducing your risk, your business risk, by buying your own pool manufacturing company. Right now, I've made my core business, building luxury homes, maybe more sophisticated, because now I can just put the pool in for you. I don't have to go out and get bids. I don't have to worry about somebody saying, sorry, I'm too busy. I don't have to worry about somebody saying, I don't have enough employees. How does 6 months from now sound? So again, the answer to your question is yes. The question in my mind is why, right? And it is a reduction of risk when you expand your services, right? You're now not subject to risk of somebody not showing up doing what they're going to do. You're not subject to somebody telling you no. You're not subject to whatever their pricing increases might be. and what that is fundamentally doing at the end of the day is it's protecting your core business with add-on products. It's making you stronger. But I would tell you, the building space, right? I can envision a situation where if I'm building 1,000 homes, it sure would be nice to have an HVAC contractor that just shows up when I tell them to, right? It sure would be nice to have electricians show up when I tell them to. And the way I can control that is if I just own them.
We saw a lot of pool companies this year start shotcrete companies and all the things they couldn't get. Mm-hmm. They hired plumbers right out from plumbing companies to plumb in-house, so they had availability. It's crazy.
A strategic buyer or a synergetic buyer in the manufacturing side, you see it in all industries, by the way. They might buy another manufacturer that has some intellectual property that they don't have, or IP, or product lines that they're not in, let's say, that they need to get into that fits well into their business side. You see that all the time. I believe at that time a strategic buyer, synergetic buyer, will probably pay you more because, man, I look at all this intellectual property I just picked up. Look at this product category that I don't have in my product category that I can now mix in with my product category. It works. It works that way.
Yeah.
Seems like you just never know what somebody's intentions are.
Absolutely.
And that's not like a bad thing. It just, there could be a million reasons why somebody would want to do that.
Yep. Do they have to disclose in the agreement if they plan to, do something specific with your company? Like, I'm sure sometimes people buy companies just to basically eliminate a competitor, right? Do they have to disclose that?
I don't think they do. No. If they're writing you a check for your keys, I don't have to tell you what they're going to do with it.
Yeah.
I think if you have rollover equity, that you're going to ask them what are your intentions. And it isn't uncommon in a sell side transaction for people when they're talking to me to say, hey, listen, these employees are my family, right? I owe a lot. My success is them. What's your intentions with my employees? I'm not interested in your 10 multiple if you tell me my task number one is to lay off half of your people because that cost savings means more cash flow in my pocket. I might say, I'm not interested in your 10 multiple. I'll take this person's 6 multiple because they're guaranteeing that my employees who have made me what I am today are going to stay on and continue the tradition. Because let's face it, your name is associated with that company. Even if you have the check in your pocket, it's still you and your name associated with those employees and their families and their lives.
Yeah.
It's kind of off topic, but have you ever heard of anybody, let's say you bought my pool building company, and I was like, I will continue to say, market the company. Like, I'm going to constantly talk about it, share photos, take photos, whatever, but getting like a royalty of every pool sold. Just being in a more, techie time where we've got social media, blogging, YouTube, all these different things. And to kind of keep the person that started it on board, what better spokesperson or salesman to kind of keep pushing the company. Have you ever heard of anything like that?
Oh yeah, for sure. The concept of a royalty for becoming an influencer for your own company, maybe not as much. But again, in the underlying contract, they're going to say, I want you. You are the identity of this company. And whether I compensate you with, if you hit X number of sales, I'll give you a kicker, or I'll give you X percent of every unit we sell from this day forward. They can structure that any way they want. But fundamentally, what you're talking about is, how do I get more than the math shows me that I should be getting for this company, right? And to the extent you're open to throwing those ideas out on the table, you might strengthen net in pocket at the end of the transaction, right? But that's where the experts come into play, right? That's where you surround yourself with a team that's done it, that understands it. They are trying to pay you the smallest amount of money they can, for sure. They are hiring people like myself to come in and beat up your company so that you're willing to take a smaller amount, right? You surrounding yourself with experts now when you go to them, you're able to throw ideas out onto the table that might resonate with them in a pure effort. Again, whether you call it a royalty per unit or whether you call it an earnout or a
Bonus.
kicker or a bonus, right? You're throwing ideas out on the table that they might latch onto that are really intended to say, the math says this, I'm asking for this because this is my child and my name, and they just might go along with it so long as you're somewhat at risk for that not happening.
I would love to see, just for fun, a Shark Tank version of somebody selling their pool company. That'd be
You
sweet.
have to Google it. Maybe it's been done.
Maybe, but that'd
There
be
is
cool to
Shark
see
Tank.
like a panel like
Sure.
you guys and just asking, the right questions. I think that's why a lot of people like watching Shark Tank is they might have a business and they're like thinking of themselves.
I could be Mr.
couldn't-
Wonderful. Yeah. I have the haircut for Mr. Wonderful.
Well,
You're much nicer than him.
Oh, I don't know. I can be tough.
yeah. I don't know if they've done that, but I'll tell you this. In my opinion, the first question that the first shark would ask you is, are you the company or is the company the company? That is paramount to that discussion. Because if I'm buying you, I need to know you're going to be around. And I need to know that you're committed, and I need to know that you're in this for me in the long haul, for us in the long haul. And your goal in that conversation is to say, you can buy me. I'll stick around. I'll do a royalty strategy where I'm gonna grow. But this company lives in and of itself. I'm not the guy. You don't want this company survives by itself if I get hit by the bus, right? But they're going to want to know, am I buying you? Am I buying the company? Most of the times in these conversations, we are showing how strong the company is without you. That increases the value of the company, decreases your value. That means you tend to stay attached less to the company. If you're interested in sticking on, we'll give you a royalty or an earnout or a bonus structure. But our goal is to say, this company duplicates everything it can. Take me out. I'm not the guy making this company work. I just show up and drink coffee and read the paper every day. That's the goal when we're marketing a pool, any manufacturing type company to a buyer. That's what I think the Shark Tank first question would be is, tell me that this company lives without you.
Yeah. That's why having a strong management team in your company is very important. They look at that.
Yes.
You hear that a lot. Like, are you a business owner or do you just have a job at your own company?
And it's beneficial to say I just show up for work every day, right?
That's exactly right.
I'm not the smart one in the room. The CEO, the CFO, the chief operating officer.
They want to hear that.
So what I'm hearing is I need to drink coffee and read the newspaper at work, right?
Well,
That's not going to happen.
If I'm trying to really pump the value.
No,
of this
what
bad
that's
boy.
saying is that, but that's also saying is having a really good second in command operations guy, strong. That if you got hit by a bus tomorrow, that guy could step in and just the business would go on.
And
That's really right. At the end of the day, that's what they want. They want that whatever that team looks like, because they have the things called like a retention bonus. It's a retention for 2 years, so you're not going to get a good bonus until that 2 years is up. But let's say you get hit by a bus, who's going to step in? They look for that. I will tell you, they did in my company, big time.
Yeah. And they're going to interview those people,
Oh,
right? And so then you get into a little deeper conversation of when do we start telling people inside of the organization that we're here? It's scary to people in your organization that you might be having this conversation. That is an entire conversation in and of itself. Is who do I tell and when, right? Because there's a lot of work. Let's face it. Garth talked about the LOI stage. I tell people a letter of intent to me, to put it into a football analogy, is first and goal from the 40, right? It looks good for first and goal, but we have a long, long way to go. That's the LOI stage in my mind. And so from that point to check in keys in hand, there's a lot of work. Make no mistake, you are going to be doing hours and hours and hours and hours of financial diligence and operational diligence and satisfying the buyer that you are what you say you are. And if you're doing that from 5 p.m. to midnight, right, because nobody in your organization knows this is going on, that can be a problem. That can take away from you actually being good at what you've been good at historically. So oftentimes we'll have a conversation about when is the right time to tell my accountant, internal account, external account, right? You need to get them in quick so that you can start to get models developed for you. But my bookkeeper, when do I tell that person? They're going to be scared right off the bat that maybe they don't have a job anymore. So when's the right time to tell them so that they can help do all of this underlying administration of the transaction? And once you've identified those key players, again, if we are selling our company as a standalone entity with me drinking coffee and reading the paper every day, they are going to want to go sit down and interview those people and make sure that they're in the game, that they want to be here. What's their CV look like? What's their pedigree? What's their strength? And are they committed and are they in? And to the extent those people are like, I'm here. This is my career. This is my passion. I love this brand. I love this family name. That, again, gives them some solace that this company does live without you.
Does your key guy, like your second guy, or does he ever find that as an opportunity to really drive his feet in the ground and go, by the way, I realize how important I am in this transaction and I'm double the money now? Does that ever happen?
They should know that ahead of time.
Really?
If you really care about the guy, that he would know that. That wouldn't change it at all.
Okay.
That's a culture in the business.
Yeah.
Those key people should know that anyway.
Yeah.
They shouldn't have that. If that's what it takes to do that, then I think the leader hasn't done a good job.
Yeah.
Yeah.
If you take that out of the equation, because not everybody runs a business as well as Buzz has, right? Then you start talking about golden handcuffs. You start talking about retention bonuses. You say, hey, listen, this is what's happening. You're so integral to this. I'll tell you what, you've been so integral to this. Sorry, I haven't told you that every day, but you are. And so what I'm committed to do is giving you X amount of financial upside based on whatever the sales price of this transaction is. So if we sell it for a 10 multiple, I'll give you 1%. If we sell it for a 8 multiple, I'll give you 0.75% of whatever the sales price is. And oftentimes then now they're financially invested in. I experience entrepreneurs. I follow entrepreneurs around and I advise them. And sometimes I put guardrails up and try to contain them and with inside of the bounds. Sometimes they jump out and I try to pull them back in. But in the entrepreneurial spirit, right? When I'm advising companies, especially second generation companies, third generation companies, right? I ask myself a question when I'm talking to the entrepreneur, and I say this: has that person ever paced the house at 3 a.m. wondering, how am I going to make payroll tomorrow? That's a different thing. That is a different person. That is a different level of humanity. That's a different conversation. It's a different level of connection between us. Because if there are people who every decision they make is brilliant because it's been built and there's a backstop behind them. If they make a mistake, it's okay. Entrepreneurs have to think in their minds, if I make a mistake, it's a disaster. It's a different decision-making tree, right? And when that happens, and Buzz is very, very, he's heard me say this to him too many times, I'm certain, but when that happens, they need to be talked to differently. Yeah. They need to be, pushed. They need to be pulled back. You have to win this one here. This is not a hill to die on. No, we have to pull this one back a little bit. And that in terms of my industry and my advisory, it's that's what makes this unique to me, right? Is getting into, talk about a team, talk about a partnership. It's getting into that space and really evolving with them. That's why I say he's taught me as much as
Buzz. You're a pro at this. You've been through it twice, or multiple, actually more than that, I believe, right? So give us some advice, some guys that are thinking about selling. Like what's your key advice for those guys?
Yeah, I think my key advice would be to run your business every single day as you were going to sell your business. Be prepared. Get the list put together. Get that curb appeal, as Josh was saying earlier. I think so many times you're working in the business instead of on the business that you don't pay attention to that. And I think if you take a step back and say, okay, maybe I'm not ready today, but maybe 10 years, maybe 5 years, and if you start now doing that checklist that needs to get done, so you're prepared when that knock does come on the door or that opportunity knocks on that door, because it's going to happen. I mean, right now, Josh says that private equity is still some going on with the pool industry, but there's cycles, and it's going to get hot again sometime, and you want to be prepared. So my best advice is be prepared, run that business like every single day, like you're going to sell the business, and do the right things. For that, you'll be the valuation down the road will pay off big time. That would be my biggest advice. Josh, do you want to add anything?
Yeah, again, just to add to that, we talked earlier about selling into a hot market versus marketing your company for sale, right? If you listen to what Buzz said there, fundamentally, if you operate your company every day like you're going to sell it, when the hot market shows up, you're ready, right? When the hot market shows up, if you are not ready, you have to pause and you have to start to get ready, right? You have to start working on it at that point. And now you've missed the hot market potentially, which I think there's some anxiety in the world today about missing of the hot market. So I fundamentally agree with Buzz. Every day when you wake up, operate the company like you're going to sell it someday. That way, when the knock shows up, when the hot market shows up, you are ready. And again, you've maximized everything you've built from the start.
So Josh, not to put you on the spot, but if you were to give the top 3 or 4 things when you operate your business every single day, what would those top 3 or 4 things you should be doing every single day to make sure you maximize that value or be ready for that hot market? What would that top 5 or 3 or 4 be?
So number one in my mind is the financial aspect of it, right? This people think in terms of, well, it's my money, it's just in one pocket or the other. Well, it's not, because you're selling only one of the 2 pockets, right? So absolutely get your financial house in order and treat it as such, right? Respect the fact that that's the corporate money and you're going to take a salary, but you're not running a bunch of things through the company, right? Because of this apparent tax advantage or some version of that. So that's number one, financial house in order. Create the financial package and respect it and honor. It's difficult. Yes, you might have to transfer money 2 or 3 times, which seems silly, especially when you're busy, right? You're treading water, you're busy, but respect it. That's number one, financial house in order. Number 2, operational, right? Get your key employees empowered to replace you one day, whether that day's tomorrow or down the road, right? That's protecting your family. That's protecting your business. That's also, again, and I hope we made this point abundantly clear, that's protecting your multiple at the end of the day when that hot market shows up. So I would think that's number 2. And number 3, I would say today, get a team assembled around you, a team that's smarter at this. Get that team built. And you may not utilize that team, you may not deploy that team till a different day, but when they are in, and they're in the know, and they have a relationship with the entrepreneur and their family, and they understand the situation, and they know what the numbers have to be. You can pull that lever at any given moment, and the team is on scene, ready to go, and they get the goals and they understand the goals. So get that team, get them in place today, even if you don't use them. And surround yourself with people that have been there before. Because I tell people, and I've heard Buzz say this, but I tell people there's cost and there's cost, right? And in these transactions, you can lose $200,000, $300,000 quickly and not even know you've lost it, just in some variable, right? We talked about normalizing adjustments on EBITDA. Well, if nobody is ready to say your salary is actually too much, it should be too small, and that is a $200,000 hit, and you multiply that times a 10 multiple, well, you've lost a lot of money quickly and didn't even know it, right? So get the right team in place, get them on scene, get them bought into your vision, your goals, and your strategy, and have them ready to deploy at the drop of a hat.
So good.
So good. Awesome.
All right. So as we wrap this up, I don't know if you saw the question, but do you have a favorite pool that you've ever visited? Maybe in the favorite Dwell magazine, favorite movie pool? What you got?
Well, do you want the nostalgic pool or do you want the Las Vegas pool? I'd tell you this, obviously my favorite pool in the world is the one that's in my backyard, right? I watched my family grow up in that pool, and we sat in there as 2 young sons and grilled, and that's I mean, that thing means the world to me. My favorite pool is a pool that probably nobody on this podcast that's not from the state of Montana will understand, but there's a bar in Great Falls, Montana, and the bar is underground, and the entire wall of the bar is pool wall, right? And so the people are swimming in the pool while you're sitting, eating, and drinking. And twice a day or something, they have these people in mermaid costumes come in, and they do all these like
Nice.
mermaid things, whatever they do in there. So again, that's a little nostalgic back to my young life growing up on a cattle ranch in Montana, and that was a favorite for me was going there and getting a cheeseburger and watching the mermaids.
Damn, Josh, you have a answer for everything.
I told you.
So if you could recommend one book, what would it be?
No doubt in my mind, 100% Simon Sinek, Start With Why. 100%. Why do I get out of bed every morning? I love working with entrepreneurs. Period. End of story. You're talking about, hey, Josh, somebody showed up and wants to buy my company. Why? If you don't know that, you can't get to a number, right? If you don't know what your goal is in selling this company, you're not going to be satisfied with the number. You're not going to be satisfied with the buyer. You're not going to be satisfied. Start every question with why. And that book, I mean, it's whatever they call it, bird-tailed and highlighted in that thing. And I pick it up and I read it. I talk to my staff people in my office, and when I I travel the country and hire accountants in our firm, and I'm like, listen, I can read your resume. Tell me why you're here. Tell me why you want to be here. And that resonates with me, and I think that's when you talk about self-reflective, why am I interested in selling my company, and you believe in that, we can get you to the end, but you got to know why you're there.
It's awesome. So for people that want to reach out to you, how can they do so?
Well, I mean, Google is an interesting thing, right? The firm I work for is called Eide Bailly LLP. We are a 105-year-old firm started in Fargo, North Dakota, which is unique for very large public accounting firms. But my contact information is on the internet, and one of the things, and this is more about your listeners than it is about me, right? But what I tell people is my commitment to humankind and entrepreneurs is education, right? I don't care what the result of this interaction is, but you need to leave our interaction better, smarter. And if I have to tell you you don't need me, you go somewhere, your person is great, stick with them. That's a value to you. So if if people bounce ideas off them, I'll give them my idea. If the answer is you're fine where you are, that's valuable to people too, right? If I came to you and said, hey, my pool's not working, you said, yeah, you don't need it, just let it go. That's valuable to me. So again, I say that out there because people, it's lonely at the top when you're an entrepreneur, right? And you need to talk to people that aren't selling you something. And again, my commitment to this industry is if you leave our interaction a better person, a smarter person with something of value, even if it is my list of worries isn't as big anymore, I'm happy to do it.
That's awesome.
Yeah. Well, we really appreciate your time. This was, amazing. I'm sure the listeners are extremely grateful for you telling all these things. So thank you again.
No, thank you. I enjoyed it very much.
Buzz, thanks again for being our Sherpa through this. We appreciate it.
No problem. Glad to be here. Hey, listen, I learn every time I talk to Josh, I learn something. So awesome. It was an awesome podcast. And I'll leave it with this, with the Simon Sinek. I listen to most every single one of his podcasts. Or not his podcast, but his YouTube. YouTube. If you get on YouTube, when I'm on my bike and working out, it's the why. He's the leadership. So much of it it's amazing. He's an amazing guy. I highly recommend it for anybody, but any entrepreneur that wants to gain knowledge. Listen to Simon Sinek. Yep, he's one of my heroes.
Awesome.
Definitely.
Do it.